The case of a young Chinese woman deprived of her personal freedom can be seen as a prime example of power asymmetry. In both law and finance, asymmetry is always the source of the most serious risks. When one side holds complete control and the other is unable to react, the outcome is often predetermined. In investing, this is a situation where the investor completely loses negotiating leverage. In personal life, it's when autonomy ceases to exist. Modern legal systems are designed to limit such asymmetry. Principles of human rights, due process, and independent oversight are not intended to create complexity, but rather to prevent the absolute concentration of power in one place. History shows that where power is unchecked, systemic risk emerges. In finance, fund managers understand this very well. They not only assess potential returns but also analyze the imbalance between. This girl's story illustrates the consequences of being isolated from the flow of information. When information flows in only one direction, an individual's ability to protect themselves is virtually non-existent. Decisions made in an environment lacking transparency tend to be decisive and difficult to challenge. In finance, professional investors constantly monitor market signals to detect risks early. Decreased liquidity, increased volatility, or unusual silence from large institutions are all considered warning signs. When signals are distorted, the market loses its ability to self-correct. The legal system, in theory, also needs similar signals. Access to lawyers, public trials, and oversight mechanisms exist to ensure that information is not monopolized. When these signals weaken, the system's ability to correct errors is significantly reduced. Another important point is the valuation of risk over time. In the stock market, risk is often not valued immediately. It accumulates gradually as information is concealed, until even a small event is enough to cause a sharp price correction. This explains why many stock crashes occur suddenly, even though warning signs have existed beforehand. The case analyzed also demonstrates similar logic. When information is limited for an extended period, the system loses its ability to self-correct. By the time a final decision is made, there is no longer enough data or time to re-evaluate the entire process. From a risk management perspective, the lesson is clear. A safe system is not one that is error-free, but one that allows for continuous information flow. In finance, this helps the market adjust prices in a timely manner. In society, it helps banks prevent decisions with long-term consequences. This case analysis is not intended to recount a personal story, but rather to highlight a general principle. When information is controlled, the risk doesn't disappear, it's just delayed. In the stock market, that delay ends in a sharp correction.